Developing the picture-perfect economy is a fine art for central bankers. They have to delicately balance a mix of solutions against exposure to risk. Now, the palette for policymakers is running out of options. After printing money with QE and then buying all sorts of bonds, negative interest rates are in focus for the central banks as their latest technique to help prevent economies from unraveling.
Sub-zero rates work by deterring institutions from hoarding funds with central banks for safety by charging them to do so. The idea being that once that cash is freed up, all banks would then be pushed to lend more to businesses and people. Flush with cash, consumers would go out and spend, in turn boosting growth and also confidence. In 2009, the Riksbank of Sweden became the very first to experiment with borrowing costs below zero.
Followed in 2015 by 4 more major central banks, including Switzerland, Denmark, the ECB and Japan. While the Fed has already started raising rates because its economy is stronger, its chair Janet Yellen says that even she has toyed with the idea of making money cheaper.
Only Mark Carney of the Bank of England has been clear in ruling them out.
But that's not to say there aren't warning lights. Some fear that negative rates can distort financial markets, and if banks pass on the cost to their customers, well, they could end up withdrawing their savings, creating the opposite effect. If today's new image of monetary policy works, talking negative could be the new positive for the markets. If it doesn't, it risks leaving a blot on the reputation on the world of central banking as a whole. Nina dos Santos, CNN Money, London.